If you are asking, how long should I wait to open my next credit card after my statement closing date? The honest answer is, there usually isn't a magic number. In most cases, you do not need to wait a fixed number of days just because your statement closed. The better question is this: what balance just got reported to the credit bureaus? And how does your overall credit profile look right now? That's because the closing date marks the end of your billing cycle, while your payment due date usually comes later. In other words, the closing date and the best application date are not automatically the same thing. Here's why that matters. Credit card issuers typically report your balance to the credit bureaus around the end of your billing cycle, which is often right around your statement closing date. So if your card closes with a high balance, that higher balance may be what lenders see, even if you plan to pay it off in full by the due date. That's one of the biggest mistakes people make. They think paying by the due date is all that matters, when in reality the reported balance can affect their credit utilization before the payment is even due. So if your utilization is currently high, the smart move is usually to pay the balance down before the statement closes, let the lower balance report, and then apply once your credit report reflects that update. As a practical strategy, that means you're often better off waiting until after a lower statement balance has been reported, rather than applying immediately after a high balance statement closes. Credit utilization matters because scoring models look at how much of your available revolving credit you're using. The CFPB says experts advise keeping utilization at no more than 30% of your total limit, and some guidance goes even further, noting that the strongest profiles often show utilization in the single digits. Here's a simple example. Let's say your statement closes on the 20th, and on that day, your reported balance is $2,500 on a card with a $5,000 limit. That's 50% utilization. Even if you pay it off on the 25th, the bureau may still first receive that 50% number from the statement cycle. But if you had paid the balance down before the 20th and let's say $200 report instead, your utilization would look dramatically lower. So if you're trying to optimize your chances for approval, the right wait time is often not a week after closing, but rather until the lower balance has actually been reported and reflected. That is an inference based on how issuers typically report balances at the end of the billing cycle. But utilization is only part of the story. A new application can also trigger a hard inquiry, and hard inquiries can lower your score by about 5 to 10 points on average. They can stay on your credit report for up to 2 years, although FICO scores typically only count them for 12 months. On top of that, opening a new card can reduce the average age of your accounts, which can also put some pressure on your score. That's why the timing of a new application shouldn't be based only on the statement closing date. It should also depend on whether you've applied for other credit recently and whether you're about to apply for something more important, like a mortgage or auto loan. So what's the bottom line? If your balances are already low, your score is healthy, and you haven't opened much new credit recently, you may not need to wait at all just because your statement closed. But if your statement just closed with a high balance, or you've had several recent applications, it can make sense to pause, let your lower balance report, and give your profile a little breathing room before applying again. There's no universal countdown tied to the statement closing date. The best timing is when your reported utilization looks strong, your recent inquiries are under control, and your overall credit profile supports the application you're about to make.